Hello, what happened to the Hindenburg allegations on Adani Group? Months have passed and everybody seems to have forgotten it. But we haven't. Welcome to the Money Trail. Remember, the Supreme Court had asked SEBI, the Securities and Exchange Board of India, to inquire into the stock manipulation allegations and had given a 2-month period to complete it. Well, it ended on May 2nd. Did SEBI complete the investigation? No. Instead, they had asked for an extension of 6 months. But the status report filed along with this, the request, has something to look into. We are going deep into it. SEBI has found out that there are 12 suspicious transactions related to misrepresentation of financials, circumvention of regulations, and fraudulent nature transactions. Don't get too excited. They are just suspicious about these transactions so far. SEBI is also digging deep around something else too. They are possible violations related to related party, which means illegal transaction between parties connected to each other but acting otherwise. They act like they don't know each other. Possible violations of corporate governance related matters. Possible violation of minimum public shareholding norms, which means holding more than 75% stocks of a public limited company by the promoters. Possible stock price manipulation in various stocks of Adani Group. Possible violation of overseas direct investment norms. This has been the eye of the storm, where Hindenburg has alleged that money has been transferred overseas and has brought back in different names to purchase the Adani shares. Next is possible violation of insider trading regulations. And finally, possible violations of norms of short selling. Then, SEBI goes on explaining that complexity of such transactions and why at least 6 months more is needed. Fine. But what happened to the investigations on complaints against Adani already given, already filed? And SEBI has said on record that they are investigating it long back. For example, the Trinamool MP Mahua Moitra has lodged one way back in 2020. She alleges that this request for extension is a plan to drag the investigation. She tweeted, "This is a joke. SEBI has been investigating since October 2021 when they replied to my letter of July. While they prima facie see violations, they want 6 months to protect their favorite businessman so that he can get maximum time to cover up." Not only Mahua Moitra, but the entire opposition is suspicious. Given the general elections scheduled to be happening in next April, they fear another extension by SEBI, and then the matter will be swept under the carpet till the elections are over. But let's be optimistic. If the Supreme Court allows the request, November 2nd will be the next D-Day. Let's see how this investigation unfolds. What happened to the economic recession scare? As boasted by our leaders, did it leave India untouched? Well, we are not sure. But the recent report says that the growth in 8 core sectors have fallen. What has rung the alarm bells is the crash in the industrial growth rate in the month of March. It took a nosedive. Compared to the preceding month of February, it halved from 7.2 to 3.6. And the growth rate in March is the slowest in the last 5 months. All of this is official data. No speculation, no private players involved, nothing. Industrial growth of the country is calculated with the performance of 8 sectors. They are coal, crude oil, natural gas, refinery products, fertilizer, steel, cement, and electricity. These 8 core industries comprise 40% of the index of industrial production. The plunge in March was driven by a decline in the output of 3 key sectors: cement, electricity, and crude oil, all key indicators of economic growth. The sharpest dip was recorded in crude oil production, which slumped by 2.8%. Followed by electricity generation that went down by 1.8%, and cement production went down by 0.8%. A clear sign of economic slowdown, but it is not fair to make a prediction with just the March data. So let's look at the financial year as a whole. For the full financial year, the core sectors in total recorded a growth less by almost 3%, from 10.4 in 2021-22 to 7.6 in the last fiscal, which ended this March. The slowdown in exports and consumer demand must have contributed in bringing down the numbers. But the government considers the setback temporary. All eyes are on the final GDP figures for this year. The GDP figure for the whole financial year will get some time to get published. What we have are some quarterly data. In the second quarter of this financial year, it was 6.3% growth, and in the third, that is from the last October to December, it came down to 4.4%. While we await the fourth and the final one, the official sting, we will make it to the projected growth of 7%. For that, in the last quarter, that is from January to March, the growth should be above 5%. Well, with the poor performance in the key sectors, we will have to wait and see. This brings us to the next logical question. What are our business community doing? Lot of billionaires have been created recently. We haven't been reading the news, and most of them are doing well. But still, our economy is not growing enough. But the real fact is, private sector investment is falling. No, not from the pandemic, but since 2010. So, for the last one full decade. Here are the details. Private sector investment as a share of GDP rose steadily since 1991, spurred by the economic reforms implemented then, to a peak of 27.5% in 2007-8. Even the global financial crisis didn't seem to have a lasting impact. It recovered after a very short period to 27% in 2011-12. But since then, the private sector investment as a share of GDP has been steadily falling. It fell to 21.3% by 2015-16. After 5 years, by 2021, the economic survey shows that private sector investment as percentage of GDP has fallen to 19.6%. But you may have seen more news about private investment creating records in recent times. Well, that's also true. Private investment hit an all-time high of Rs 10.5 lakh crore in the last quarter, that is from January to March. But that's in absolute terms. We are talking about the percentage of GDP. When it is looked at as a percentage of GDP, this 10.5 lakh crore, it works out to just about 15% of the gross domestic product. Why is that? Lack of consumer demand? The conventional belief is that private sector investment is driven by demand, whether domestic or from abroad, in the form of exports, But the data for India, however, shows that this doesn't seem to be the case. Private final consumption expenditure, which is the amount households spend on consumption, has been falling as a percentage of GDP ever since 1950. It fell steadily to 55% by 2010-11 from 89% in 1950-51. However, at the same time, private investment as a percentage of GDP rose to 25% in 2010-11 from just 8.8% in 1950-51. The next few years saw consumption expenditure rebound somewhat to 61% by 2019. But as I said earlier, this was the period when private investment was falling. Then what could be the reason? Another possibility is corporate profitability. Means companies invest more when they make profits. Ever since the COVID, big corporate houses have been making huge profits. You must have read everywhere about this. They have replaced small players affected by COVID-induced lockdowns. And still, the private investments didn't increase as the share of GDP. The problem seems to be a more unquantifiable one. A general lack of confidence in the way the Indian economy is being managed. It's just a speculation, but we don't have any other option. Or a fear that the future is not very promising. The business community don't have a confidence in future demand. Well, if this is true, this is really alarming. All the money spent by the government from their exchequer, selling their assets to boost private investment also, is going down the drain. Now it's time for some quick glance of other important developments. Demand for the National Rural Employment Guarantee Scheme rose for the third straight month through April and scaled a 10-month peak. Less jobs in other sectors is forcing millions to opt NREGA last month. 31.84 million people opted for work under the scheme. Remember, the central government in the last budget had made drastic cuts in the funds for the scheme. The goods and sales tax collection touched a new record of Rs 1.67 lakh crore in April, first time crossing 1.5 lakh crore. This is the 10th month in a row that GST revenues crossed 1 lakh crore. Government claims this is proof of improved economic activity. Officials link it to increased tax compliance, and some economists link it to the spiking inflation. The central government extends the deadline for the Smart Cities mission again. The prestigious project for 100 chosen cities was the first mega infra project of the NDA government. Launched in 2015, the original completion date was 2020. Now it stands extended to June 2024. The Union government approves provision for the ambitious National Green Hydrogen Mission for Rs 20,000 crore. With the fund, a special product-linked incentive scheme will be formulated to set up a manufacturing base for electrolyzers and other green hydrogen equipments. The big dream of the government is production of 50 lakh tons of green hydrogen per annum by 2030. Carbon border tax imposed by the European Union all set to further dampen Indian exports. The new tax imposes importers and non-EU manufacturers to pay for the carbon emission linked to the goods they sell within the European Union. This could significantly impact the prices of Indian-made goods in the EU markets, upsetting demand. Well, that's all from us in this episode. Goodbye till we meet again.